Hello, this is Chuck Carnevale, also known as Mr. Valuation. I present this short video in order to introduce what I like to think of as the three phases of valuation. One of the things that I think is misunderstood about assessing fair valuation of a common stock is that in order to do it effectively, you really have to implement three different phases. You have to look at the past, the present, and most importantly, the future prospects of each company you're looking at before you can make a fair and reasonable assessment of fair valuation. For this video, I purposely chose the dividend contender Meredith Corporation because I believe this particular stock gives us a lot to think about when we're assessing fair value, or whether or not it's fairly valued. Phase one of assessing fair value is to start by looking at the current PE ratio in relationship to the company's current earnings. In the case of Meredith, using yesterday's closing stock price, we have a current PE ratio of 12.3. I'm using the blended PE ratio here. Note that the orange line on the graph represents a PE ratio of 15, and that's my valuation reference. So anywhere I'm touching this graph, including the forecasting years, I'm utilizing the valuation reference of a PE of 15. Clearly the price is below that line, i.e. a current PE ratio of 12.3. But I would also like to point out that in this particular company, if I take price off of the graph, forecast for fiscal year end 2016, which ends in June, is for a slight drop in earnings. So that's a consideration looking at the present value, or phase one. Since I consider this company fairly valued on a present value basis, or phase one, I now look at the long-term historical operating earnings, which is the orange line in the graph, as well as how the market has typically priced those. And there's a couple of things that I want to point out very quickly. First of all, by taking price off of the graph and the normal PE, we see that there is a certain amount of cyclicality in this company. It does have an excellent record of increasing its dividends, which are depicted by the white line, which are much more consistent, as I talked about in the article. But when you're looking at this stock historically, you should be aware that the company does go through different phases of earnings growth, and some cyclicality mixed in with that. When I bring price back into the equation, these are monthly closing stock prices, I do see that there is a high correlation between stock price and operating results, or the orange line. And obviously the best times to be buying a stock like this, or any stock for that matter, is when the price is in an undervalued territory. You can buy a stock when it's undervalued, as I mentioned in the article, and still see it lose money over a short period of time. However, in the long run, the dividends and the stock price ultimately move along with the earnings. The other thing I mentioned in the article is going through multiple time frames. So I want you to notice the growth rate here of 4.6%. But watch what happens to that growth rate as I go through different time frames here. And so I'm assessing what's been normal and what the company's historical growth has been able to accomplish. And this way I'm just getting comfortable with how the market values the stock and how it has functioned on an operating basis. With Meredith Corporation, I would have some concern about the cyclicality of the earnings. After I've gone through the process of looking at current and historical norms, valuations, and operating results, I now turn my attention to the more important future. And with Meredith, I think a lot of the downward stock price movement we've seen throughout the majority of 2015 can be attributed to the expectations of some softness in earnings for fiscal year 2016. However, this is very normal for the company. As we increase the time frame here, we see that it's not unusual for this company to go through periods of modest drop in earnings followed by rises in earnings. And the forecast for 2017 is for 18% growth as we look at the current estimates for 2017 beyond 2016. So that's a plus, but again, it's a long term. So at this point, I would move to looking at forecasts. And what's interesting, when you look at, this is not a highly followed company. There are only 7 analysts forecasting this year, 6 analysts forecasting next year, and then only 2 analysts forecasting the following year. And what I see here would be what I would consider more of the same for this company. So if I run some calculations looking at what my returns can be, my total returns can be looking out forward. Buying this stock at a 12 PE certainly mitigates some of the risk of the cyclicality of earnings. The dividend yield is very attractive at 4.7%, and their long-term dividend record excellent. So that's how I would assess the fair value of Meredith Corporation. I've looked at the past, noted the cyclicality, evaluated the present valuation, which I consider attractive, and then have reasonable expectations to make money, assuming that stock price eventually moves in line with earnings going forward. Valuation is a three-phase process. You must look at past, present, and most importantly, the future prospects of the company, because that is where your return is going to come from, the future, not the past. This has been Chuck Carnevale saying thanks for listening.